In terms of those Fed expectations, if you will, how does that play out for financials, which are down about 5% year to date, but I should say relative to the S&P's loss, still outperforming?
So I just heard the discussion that you all were having about macro forces, and they are absolutely at work in the financial stocks and in the bank stocks. Broadly, the XLF, the financials have been outperforming the market. But when you drill into the financials as to which stocks we think are really going to work or are working, large regional and regional banks that are spread lenders, higher rates are going to be very good for them. We're looking for double-digit revenue growth for regional banks. But there are other areas of the market where current conditions are getting a little bit more uncertain. So there are other areas of the market, whether it be the mortgage business, subprime consumer, or investment banking revenues. Those are going to be a different story, we think, when companies report earnings in a couple of weeks. But we're bullish on the large regionals. Those have been the best performing stocks within financials, and we think things are playing out right for them in terms of the rate outlook. Remember, banks weren't built to operate in a zero interest rate environment.
So when you talk about those uncertainties, are you already starting to see, I guess, some cracks in some of those areas of the market? And I ask that because we have seen the risk of recession, or at least the risk or expectations around the risk of recession among some Wall Street strategists and economists growing.
I think absolutely. As a matter of fact, we put out a study this morning where we looked at the credit card companies, and we put a more traditional PE ratio on the stocks to try to back into how much credit loss investors may already be expecting. And actually, if you did that work, which is kind of it's a very blunt instrument to do that, an analysis to do that work, but you would say that investors are thinking that credit costs are going to go up 40% and be the highest rate we've seen since the global financial crisis. So that is already what's starting to bake its way in. And you can see investors already starting to add a risk element to some of those stocks.
But Tom, so has that changed your overall view? I mean, as we came into this year, there was a lot of, I'd say, optimism from many of the large banks, given the interest rate environment, the possibility of significant net interest margin, not to mention an economy that was very strong. A few months later, those things look very different.
Yeah. So when you think of like the view on the banks, so I think you need to break it into the pieces. We were coming out of the pandemic very bullish on the large banks. And 2021 and 2020 were very big investment banking years. We think, for example, in equity capital markets in the first quarter, you just need to look at what's been priced. Those businesses are going to be down significantly. Trading's going to be down double digits year over year. And so there's a chance you can get yourself all bared up on it until you take a step back and you look at what our estimates are for the year. We still think 2022 is going to be better than 2019. And the story may be just we're off record levels, but it still is going to be a very reasonable year for investment banking. And when I look at returns on tangible common equity for these big banks, it's still mid-teens, which is still pretty good. They're still going to raise dividends. They're probably still going to buy back stock. But we don't really recommend those stocks because of the decel. Where we are is we like Comerica, we like M&T, we like PacWest, we like Western Alliance, we like East West, which are banks that generally don't have a lot of mortgage exposure, and they also don't do a lot of lending to subprime consumer, which is where, I heard the percentages you said this morning. That's where the range of outcome is probably widening out as inflation continues to pull away, as rates go higher, as gas is over $5 a gallon. You could see how the economy could slow faster than folks had originally thought when the year started.